Did you know the stock market isn't just numbers and charts? It's full of animals representing different types of investors and strategies. From bulls in the stock market to bears in the stock market, and from pigs and sheep to institutional investors like elephants, each animal reflects a mindset, a strategy, or a market behavior. In this video, we'll explore each of these stock market animals, understand what they mean, see real-world examples, and learn lessons for your investing journey. Section 1. The bull in the stock market, 1-3. Let's start with the most famous, the bull in the stock market. A bull market happens when stock prices are rising and investor confidence is high. Bulls represent optimism. They buy more stocks because they believe the market will continue to climb. Think about the long bull market from 2009 to 2010-20. Investors kept buying, prices kept rising, and companies expanded rapidly. Bulls in the stock market usually invest long-term, trust the economy and fundamentals, stay confident during uptrends. Lesson: being a stock market bull can build wealth steadily, but overconfidence without caution may create bubbles. Section 2. The bear in the stock market, 3-5. Next, the bear in the stock market. Bears anticipate falling stock prices. In a bear market, investors sell or short stocks to profit from declines. The 2008 financial crisis is a classic example. Fear dominated, and many investors panicked. Stock market bears are typically cautious and risk-averse, focused on capital preservation, sometimes pessimistic about the economy. Lesson: bears teach us to protect investments during downturns and manage risks, but being overly bearish can mean missing long-term growth. Section 3. The stag in the stock market, 5-6-30. Stags in the stock market are short-term investors. They focus on quick gains, often during IPOs. Stags buy newly launched stocks and sell them quickly for profit. For example, during the Zomato IPO, many short-term investors acted like stags, flipping shares within hours. Lesson: timing is critical for stags. Quick profits are possible, but high risk is involved. Section 4. The sheep in the stock market, 6-38. Sheep in the stock market simply follow the crowd. They buy and sell because everyone else is doing it, not based on research or strategy. This behavior can lead to losses, especially during bubbles. Example: the dot-com bubble. Sheep investors piled into internet stocks without understanding the business models. Lesson: following the herd can be dangerous. Always research before investing. Section 5. The pig in the stock market, 8-9-30. Pigs in the stock market are greedy investors. They chase huge profits quickly, often taking massive risks without research. Remember, bulls make money, bears make money, but pigs get slaughtered. Lesson: greed can destroy investments. Steady, disciplined investing beats chasing shortcuts. Section 6. The wolf in the stock market, 9-30-11. Wolves in the stock market are cunning, aggressive, sometimes manipulative investors. They spot opportunities during volatility and may engage in unethical strategies like pump and dump. Example: hedge funds occasionally act like wolves, capitalizing on panic selling. Lesson: wolves show us the importance of sharp strategy, but unethical moves are risky and illegal. Section 7. The turtle in the stock market, 11-12 guys. Turtles in the stock market are slow, patient investors. They invest consistently over time, relying on compounding and disciplined strategies. Turtles may not see flashy gains immediately, but long-term results often outperform speculators. Lesson: patience is a superpower in investing. Section 8. The shark in the stock market, 12-13. Sharks in the stock market are aggressive opportunists. They thrive on volatility and target inexperienced traders, profiting from mistakes others make. Hedge funds sometimes behave like sharks, always on the hunt for opportunities. Lesson: study the shark's strategies but avoid reckless trading. Section 9. The elephant in the stock market, 13-30. Elephants in the stock market represent institutional investors, mutual funds, pension funds, and large corporations. When elephants move, markets notice because they trade massive volumes. Retail investors often watch elephants to anticipate market trends. Lesson: Follow market leaders, but remember, elephants move slowly, so patience matters. Conclusion, 1430-1500. So the stock market is like a jungle of animals, but in reality, these are investor personalities and strategies. Bulls, bears, stags, sheep, pigs, wolves, turtles, sharks, and elephants all teach us lessons about psychology, strategy, and risk. Which animal are you in the stock market today? A confident bull, a cautious bear, or a disciplined turtle? Comment below. If you learned something new, hit like, subscribe to AI Finance, and share this video with someone who wants to understand market behavior.